Meta shares are down 30% from their all-time highs, over $760 a share. So we're trading it now at about 556 as of this recording. They're down more than 15% so far in 2026. It's just been absolutely a brutal year so far for shareholders, myself included. But in this video, I'm going to talk about a few big reasons why I think the stock is a really good buy for long-term investors at this price. And one big reason that I think investors do want to have a little caution, and I'll go into that towards the end of the video. But first, let's jump into some of the big reasons why the stock is a buy right now. The first big reason to love the stock right now is growth in the core business, which is advertising. And that was up $8 billion from quarter to quarter in Q4, from $50 billion to $58 billion. And if you go a year prior, that was up more than $12 billion, from 46 billion or so to 58 billion. Now that's a 23% increase for the quarter and a 22% increase for the full year. And that's comprised of two big factors moving in the right direction. 13% more ads. So the volume of ads being shown on feeds in Instagram and Facebook were up 13% in the last quarter. And they were also charging more for those ads. So Meta was charging a 6% higher rate for each one of those ads. And all that's being driven by positive engagement. User growth was up 7% to 3.58 billion daily active users. Now, that's not monthly active users. We're talking about users on the platform every day. And Meta also used that increased engagement to get a new record in average revenue per user that hit $16.56 a share, up from $14.25 a share in the fourth quarter of the prior year, 2024. So, and we're talking, that's the biggest year by far, the biggest quarter by far of the year for Meta. So we got more users generating more advertising income each day, and all that feeds into fantastic revenue growth overall for the business. The company added nearly $40 billion, or 22% to its sales base in the past year, crossing $200 billion in revenue. The second big reason to like Meta stock right now is profit power. Now, the story here isn't quite as linear. You can see from this chart here that profit margin was 41% of sales in late 2023, before rising to nearly 50% of sales in late 2024, when the company was focused more on cost cutting, and it dropped down into the low 40s for a lot of 2025 and hit 41% of sales in this most recent quarter, compared to 48% a year ago. I think Wall Street analysts made too much of a deal about that profit margin shrinking from 48% to 41% in the Q4. If you zoom out a little bit, the profit picture looks a lot better and a lot steadier. Operating profit margin was 41% of sales for all of 2025, compared to 42% of sales for the previous year. And the company is still extremely profitable. Meta generated over $83 billion in operating profit this year. That's 20% above the prior year. And again, this boost is being driven by really strong engagement, user growth, and strength in the core business. And just to put that 41% profit margin into perspective, that's well ahead of peer Apple and approaching the leader Microsoft, because Microsoft gets about 50% of operating profit and Apple is around 32% mark. So you can buy Meta today, given the fact that it's right in between those two figures, at a pretty compelling PE basis of about 23 times earnings, which is a bit less than Apple and about the same as Microsoft. The third great reason to like Meta stock right now is its bold bet on the future. We can see here that capital expenditures in 2024 amounted to about $40 billion, and they doubled that spending roughly to $72 billion in 2025. Now, almost all of that was AI bets, cloud spending, infrastructure spending on data centers and things like that. Meta is definitely going all in on that. And management's calling for higher spending this year, and so they're calling on profits to be roughly equal with what we saw in 2025. So what that implies is generating the same amount of profit on a roughly 20% increase in sales, if management's able to make that, will give us a lower profit margin for 2026. That's probably going to be closer to 35% of sales, perhaps approaching Apple's 32% figure. But I don't think that's as bad as Wall Street is fearing. You know, Meta is definitely one of just a handful of companies that can afford to spend over $100 billion on AI in 2026. And this spending should position the company for leadership in the industry for the next coming decade or many years to come. Now, it's definitely a risk, but I'd look at the company's history of making expensive bets, including the pivot from desktop to mobile and the push into video advertising in most recent years. And that really gives me confidence that I think management's making good spending decisions here. Now, one big thing to watch as a risk, though, is the cash flow trends. You can see operating free cash flow was $52 billion for the 2024 year, and that declined to 43 billion last year and probably will decline more in 2026. And that's not really good news, and definitely something that investors are going to want to watch. It's not a deal breaker, but as a shareholder, I'm definitely going to be focused on this metric in 2026, looking and into 2027. I want to see that metric stabilize, and I want to see Meta get back to expanding its free cash flow from there. But Meta is valued at about 22 times earnings, given all of that right now. And I think that would be an absolute steal if profits were growing as fast as sales, as they have been for the last several years. Instead, we do know that 2026 is going to be a kind of rebuilding year as profitability declines. But I don't think that's a good enough reason for the stock to be down 30% from its recent highs. Investors can take advantage, I think, of that pessimism to buy a great stock, one with ample profits, strong growth, and a dominant hold on the digital advertising industry at an attractive price. Now, if you like stocks like that, make sure to take a look at my recent video highlighting Roku as a great buy right now.